If you've ever heard someone say, "I got a raise and it put me in a higher tax bracket, so I actually made less," this video is for you, because that sentence feels true. Your paycheck changes, your refund changes, and it's easy to blame the bracket. But tax brackets do not work the way most people think they work. By the end, you'll be able to do two things. 1. Explain tax brackets in one clean sentence. 2. Look at your own pay stub and spot whether a surprise tax bill is really about brackets or about withholding. Picture this. You make about $72,000 a year at your job. Around the holidays, you pick up overtime and end up earning another $6,000. Your friend says, "Careful. That overtime will push you into a higher bracket and you'll lose it to taxes." Let's fix the model. Here's the reality in one line. Only the next dollars get taxed at the next rate, not your entire income. Think of your income like a set of buckets stacked in layers. The first layer is taxed at the lowest rate. The next layer is taxed a bit higher, and only the dollars that spill into the next layer get the next rate. Two terms help here, and they're easy. Your marginal rate is the rate on your next dollar. That's the rate that applies to the overtime slice. Your effective rate is your total income tax divided by your total income. That's the average rate across all the layers. Most people accidentally use the effective rate when they should use the marginal rate, or they do the reverse. They see a refund and think their tax rate was low, or they owe and think their tax rate exploded. Here's a simple example with rounded numbers. Say your total taxable income lands around $72,000. Your total federal income tax might come out to something like $10,000 to $12,000, depending on deductions and filing situation. If it's $11,000 on $72,000, your effective rate is about 15%, but your marginal rate on the top slice can still be around 22%. That's why it's normal to keep less than $1 for every extra dollar. It's not punishment. It's just how a progressive system is designed. Now, let's make it concrete with the overtime example. Say your overtime adds $6,000 of extra income. Even if every one of those dollars lands in a higher layer, that does not mean the rest of your income gets re-taxed. It just means the overtime dollars are taxed at that higher marginal rate. If the marginal rate on that slice is around 22%, then the federal income tax on $6,000 is about $1,300, rounded. 6,000 times about 22% is about $1,300. And there's another piece that makes the paycheck feel even more taxed than it really is: payroll taxes. For most employees, there's a Social Security and Medicare tax taken out of each paycheck. Put together, that is about 7.65% on wages up to certain limits. So, a fast, narration-safe overtime math is this. Take your overtime dollars, multiply by your marginal federal rate, maybe around 22%. Add about 8% for payroll taxes. Then add whatever your state income tax looks like, if you have one. If you use 22% plus 8%, you're around 30% before state tax. On $6,000, 30% is about $1,800. That would leave about $4,200 as a rough after-tax number before any changes in benefits or retirement contributions. It's not exact. It's a quick way to set expectations so the paycheck doesn't feel like a mystery. That means the overtime still leaves you with the majority of the money. And that is before you even talk about other items that affect your paycheck, like retirement contributions or health insurance deductions. So, why does the myth survive? Because people don't experience tax brackets directly. They experience withholding. Withholding is the amount your employer sends to the government from each paycheck. It's a prediction system, a decent one, but not perfect. And it can change fast when your pay pattern changes. When you work overtime or get a bonus. Payroll software often treats that paycheck like it represents your new normal, so it withholds as if you earn that higher amount every pay period, all year. Then the next paycheck comes back down, and the withholding changes again. That whiplash feels like a bracket trap, but it's usually a withholding calculation reacting to a weird pay pattern. Go back to the same person making $72,000. They work extra shifts in December. That December paycheck might have much higher withholding than usual. Not because all of their income jumped into a new bracket, but because the system saw one large check and assumed this person makes this much every period. That's the first big decision rule to remember. Refunds and amounts due are about how much was withheld versus what you actually owe. They are not a scoreboard for whether your raise was worth it. Here's a quick way to say it. Your tax is the bill. Withholding is the payment plan. Sometimes your payment plan overpays and you get a refund. Sometimes it underpays and you owe at filing. That does not automatically mean your tax rate change in a dramatic way. Now, the practical question is, how do you tell which one is happening in your real life? I want you to watch 3 signals. They're simple, and you can check them without guessing. Signal 1 is on your pay stub. Look at year-to-date federal income tax withheld. Not this paycheck, year-to-date. If you are halfway through the year, that number is your progress on the payment plan. If it's very low compared to your year-to-date wages, you're on track to owe. If it's very high, you might be setting yourself up for a refund, which is not bad, but it does mean your take-home pay is smaller than it needed to be. Signal 2 is also on your pay stub, year-to-date taxable wages, and whether that number is jumping because of a bonus or a big overtime stretch. If your income comes in bursts, withholding will usually look jumpy too. That is a timing effect, not a bracket effect. Signal 3 is your projected result. Use a tax software estimate you trust, or the Internal Revenue Service withholding estimator, and update it after the pay change. You are not trying to hit a perfect number. You're trying to avoid a surprise. Now, let's revisit the overtime example with those signals. Say it's the end of December. You made the extra $6,000. You look at your year-to-date withholding and it's up more than you expected. That does not mean you lost the overtime. It likely means payroll withheld more aggressively on the big checks, and you may get that back as a refund. But flip the situation. Imagine you change jobs mid-year and your new job withheld less. Or you have 2 income streams, like a salary and side income, and neither one is withholding enough. Then your year-to-date withholding can be behind even while your income rises. That's how people end up owing and feeling betrayed. Here's the part most people miss. What hurts isn't a higher bracket. What hurts is cash flow surprises. If you owe $2,000 at filing, that is a real hit to the month you pay it. And it often lands at the same time as other spring costs. That's why this matters for taxes and retirement, and for budgeting and saving. It's not about the theory, it's about timing. So, how do you prevent the surprise without turning your life into a tax project? Use a simple decision table based on one variable. How stable is your income pattern? If your income is stable, meaning you get roughly the same paycheck each period, your withholding is usually close. In that case, your goal is small adjustments only when something changes, like a raise, a new benefit, or a new retirement contribution. If your income is lumpy, meaning overtime, bonuses, commissions, seasonal work, or multiple jobs, then your withholding will often be wrong in either direction. Your goal is to build a buffer and do quick check-ins so you do not get blindsided. Let's keep using the same person, $72,000 base pay plus overtime. If they do overtime only once in a while, a high withholding paycheck is not a problem. It often just means a refund later. The real risk is if they are depending on that overtime to cover bills, because the extra cash they expected may not show up in the same month. If they do overtime regularly and it becomes the new normal, then that's when it is worth updating withholding, so the year-to-date numbers match reality. Here's a clean if-then rule. If your take-home pay changed and you cannot explain it with a benefit deduction change, then check year-to-date withholding as a percent of year-to-date wages. If that percent changed a lot, withholding is the reason your check feels different. And here's the reality check. When someone says, "I made more and I owed more," that can be completely normal. If you make more, your total tax bill usually goes up. That is not the same as saying your whole income got taxed at a higher rate. The real question is whether your net extra money was worth the extra time or stress. That depends on your personal costs. Commute, childcare, burnout, losing benefits, or losing time for a side project. Taxes are just one piece. Now, I want to address one specific scenario that creates the most confusion: a bonus. Bonuses are commonly withheld at a flat federal rate by payroll systems. That can feel brutal in the moment, but the key word is withheld. It is not always what you ultimately owe on that money. Your final tax depends on your full year picture. So, if you get a bonus and it looks like half vanished, pause before you rage. Check the pay stub lines. See how much was withheld for federal income tax, payroll taxes, and state. Then remember that your tax return is the true settlement. This brings us to the 2-minute checklist. This is the part you can actually do this week. First, pull up your most recent pay stub. Find year-to-date taxable wages. Find year-to-date federal income tax withheld. Second, do a quick ratio. Year-to-date withheld divided by year-to-date wages. You are not trying to compute your exact tax rate. You are looking for a sanity range. If that ratio is very low and you had income increases, you may be on track to owe. If that ratio is very high and your pay is stable, you may be over withholding, meaning your take-home is smaller than it needs to be. Third, look at what changed. Compare this pay stub to a pay stub from before the raise or before overtime started. Look for the one-line item that moved: federal withholding, state withholding, retirement contributions percent, or a benefit premium. One of these usually explains the surprise. Fourth, if your income is lumpy, stop relying on one paycheck's withholding as the signal. Use the year-to-date numbers. That's the only way to smooth out weird weeks. Fifth, if you want a cleaner estimate, run a quick projection using a tax software estimate you trust, or the IRS withholding estimator. Then adjust your W-4 only if the estimate says you are meaningfully off. You are aiming for fewer surprises, not perfection. And last, one mindset shift that saves a lot of stress. A refund is not a bonus. An owing is not automatically a failure. Both are usually just the result of how your payment plan matched your real bill. The bottom line is simple. A higher bracket does not erase the money you already earned. Only your next dollars face the next rate. If your paycheck feels wrong, the culprit is usually withholding timing, not a bracket trap. If this helped, subscribe to the Wealth Blueprint for more clear money breakdowns. And leave a comment with the next topic you want covered, or the one part of today's video you want explained even simpler.